This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with our experts Manus, Clancy, and Dianne Crocker. This week, we saw a number of somber headlines like the warm CPI and hot PPI prints, and another move higher for Treasury yields. Here we go again with another test for commercial real estate. Manus, what's your take?
Well, I would say it was another Bizarro week for the markets, you might say. And it comes on the heels of 5 or 6 consecutive Bizarro weeks. And what do I mean by that? What we've seen is, as you pointed out, very negative or concerning headlines over the last couple days. First, we started with that warmer than expected CPI number, which was concerning but not alarming. But that was followed up with the PPI number, which was alarming. And of course, that triggered another march higher in bond yields. And yet, what we're talking about today is more froth in the equity markets, more all-time highs for the S&P 500, a real melt-up in the NASDAQ, and it looks like today the Dow will crack 50,000. So we're living in a world that's very bifurcated. On the one side, there are warning signs everywhere. The CPI numbers were concerning, and the PPI numbers were red hot, and yet the markets continue to rally like it's the year 2000, that we are on the cusp of the dot-com bubble. So it's hard to square. I do think that the commercial real estate markets will get tested again. They have been tested several times over the last year, from tariffs to the war in Iran to $100 oil to weak job numbers to the threat of AI layoffs, dismal home builder sentiment, weak consumer confidence numbers. All of those things reflect concern among U.S. home builders, among U.S. consumers. They're not the sign of a robust economy, and yet CRE continues to soldier on, running through these negative headlines like Eric Dickerson used to run through a defensive line back in the day for the LA Rams. So interesting times, Dianne. I'm interested to hear your perspective.
Well, thank you for saying who Eric Dickerson was, because I had no idea. Not a football person. But I think, seriously, the market's wrestling with a lot of questions right now. On the one hand, you've got this macro backdrop that, it's getting more difficult by the week. And the things that you just ran through, they could be and they should be slowing activity down more meaningfully than they are. The latest LightBox CRE Activity Index that we talked about last week stayed in the triple digits for the 4th consecutive month in April and actually hit its highest reading of the year. So that tells us the underlying transaction pipelines and lending activity are still remarkably durable. I think the big question now, and we've talked about that here a lot, is how long can the momentum hold with rates staying elevated with the conflict in Iran? I will say I talked to John Salmon. He is a wonderful client of ours, an environmental due diligence consultant, and he came to our Seattle roadshow. He told me privately that he thinks that when the market does turn south for whatever reason, whether it's the war or something else, he thinks it will fall hard and fast. And man, it brought to mind your Jenga analogy from last week, and definitely a sign that concerns are rising. And I have to say, Manus, your weekly commentary that got posted yesterday sounded a bit more somber than usual. And I'm sensing that you're eager to have a different story to tell, but that you're getting more concerned maybe that things are starting to tip toward a glass half empty. Did I read that right?
Well, I think with every step we take higher in interest rates and every new all-time high we set in the equity markets, I become more and more concerned. There's no doubt about that. At some point, we will reach a tipping point with interest rates and people will tap the brakes. Is that 450? Is that 475? Is that 5 on the 10-year? Only the markets know. None of us can predict. It feels a little bit like January of 2000. For those that are young or youngish, who don't even remember the great financial crisis, let alone the dot-com bubble, that was an extraordinarily painful time. We were seeing companies with no revenue, with just funding and a dream and maybe the name of a website, being valued at 9 figures they would go IPO, they would see their price double or triple or quadruple in one day. The markets were melting up on a daily basis. And then the rug got pulled out of the markets in March of 2000. And the sell-off was extraordinarily painful. The NASDAQ, if I remember correctly, was down 75% at one time from its all-time high. I'll have to go back and check that. But it all started with a Barron's article. They said most of these companies are going to run out of money in 6 months. And it was like the emperor has no clothes. People finally realized that this is unsustainable, and the sell-off was brutal. And you have to ask oneself, does this happen again here? We've seen this incredible melt up in tech stocks that are expected to be AI beneficiaries. We have no idea what the monetization window will look like once AI starts, how long this chip buying and data center building frenzy will continue. And it does feel at times a little bit like 2000. And I do think that a sell-off of 20 or 25%, like your colleague spoke about, or bigger, would jolt the markets. And I do get more worried about that with every day.
Yeah, I mean, the stock market's setting records by the day, and the higher it goes, the farther it's going to have to fall. And that, you're right, that's exactly what John was referring to, that it could be a pin like that coming out of the Jenga pile that kind of sends everything tumbling. And, the other strange thing that happened this week was the comments by Susan Collins at the Boston Fed, making headlines because she started talking about the possibility that the Fed might need to raise rates if inflation pressures broaden. And by the way, the new Fed chair also got confirmed this week. But reading about Susan Collins' comments got me thinking, a few months ago, who was even talking about the possibility of not rate cuts, but that we might actually see a rate hike? So her comments struck me as a sign of just how much the inflation picture has changed since the conflict began. And there's a shift away now from assuming that the next move will be a cut to the possibility of things swinging in the completely opposite direction.
It's funny. I'm really glad you brought up the Susan Collins remark from yesterday. I was sitting on my couch watching CNBC with my laptop on my lap, ironically, as I normally spend my mornings, kind of keeping one eye on CNBC and two fingers on my laptop as I hunt and peck. But I thought her remarks were not terribly constructive. And I'll try to peel back the onion on why, and I'd love to get your thoughts. She talked about CPI and PPI and rising inflation and the need to perhaps raise interest rates to offset these numbers. I thought that was a complete misreading of where we are now on that side of the fence. In my opinion, $100 oil is the equivalent of a rate hike, and the bond markets are disciplining themselves. These higher rates are a reflection of the bond markets reacting to $100 oil. There is no lack of discipline in the bond markets. And when you start talking about rate hikes, it's to cool off a surging economy. $100 oil is already doing that. It's already taking money out of the wallets and pocketbooks of men and women around the country. It's already driving prices higher. We don't need the Fed to raise interest rates to cool off the U.S. consumer. The U.S. consumer is already, not underwater, but I would say treading water. Let's call it that. It would have been more constructive had she said, and I think she probably believes this, the more honest thing would have been to say, we want to raise rates to take the punch bowl away from the equity markets. That would have been more constructive to say, look, we know that the U.S. consumer is struggling. We know that higher prices are a tax on the U.S. consumer. We know oil prices threaten our recovery here, but we can't overlook the fact that when some stocks are surging 100% in a month, that this doesn't feel like 2000 again, and it's time to take the punch bowl away. I think that would have been more intellectually honest and better for people to consume. Instead, she gave us the CPI PPI story, which I think undercut her message.
Yeah, it's interesting, and it would be a double hit to the growth picture as you just outlined. And I'm kind of curious if any other Fed members come out with a view that's more in line with what you just outlined. And also, curious to see what this new Fed chair has to say. Certainly in his comments the other day, he seemed to really lean in hard on the fact that the Fed will stay independent and make decisions that are warranted by the data. But I think he's trying to stay in a safe lane right now in his first kind of comments out of the gate.
I certainly don't want to see a frothy market get frothier. That does feel dangerous to me. But if President Collins' remarks were really a reflection of what other people in the room are thinking, it would show an inability to kind of tear up the old playbook and adjust accordingly. We haven't seen a shock like this in oil prices in a long time, certainly not a sustained one. And I do think that there has to be a balance between what the impact of higher oil prices are doing, along with the froth in the equity markets and the decisions that will be made in the near future. But as usual, Dianne, I'm going to throw a curveball at you because this is Thursday morning and I can't avoid throwing a curveball at you. For those that want to know what this goes like behind the scenes, a little inside baseball, Alyssa and Josh and Dianne and I, during the week, we share stories with each other that we want to talk about or we find interesting and so forth. There isn't a lot of scripting of this. We may produce a primitive kind of base outline to go through certain stories, but most of it is off the top of the head. But we do try to share stories so we can each read what's on other people's minds. But in typical fashion, there's one story each week that I don't give to Dianne, so she has to adjust on the fly. And I don't do it on purpose. I just happen to see it 5 minutes before we hit record. And this is this week's story, Dianne. This comes from Commercial Observer. Emily Davis. Multifamily starts at their lowest level since 2011. So fewer and fewer people putting shovels in the ground. If I'm not mistaken, I believe the data she referred to was from CoStar. And this is one of those good news, bad news stories. Give me your hot take, because it can't be anything but a hot take since I'm just giving you this story for the first time, on what it means that multifamily starts, construction starts are at their lowest level in 15 years.
I suddenly feel like I'm in college economics 101. That was such a long buildup. I'm sitting here getting nervous thinking, what the heck is Manus going to throw my way? Seeing the starts down and the development down, I mean, there was so much construction happening in multifamily years ago. And so that sector is going through an important kind of rebalancing and stabilization. So in some respects, less development should be a nice push for rental growth, which I know some metros have really, really struggled with of late. So that's the silver lining there, is that it makes it more attractive for owners and for investors in areas where the demand might actually start to catch up with the supply if there are fewer new units coming online. How did I do?
I thought you did great. A+, Dianne, as usual. If you were one of my students, you'd certainly get the gold star for that answer. But I imagine that in college you did pretty well. You know your stuff. So I'm not at all surprised.
But I feel like there's a follow-up question coming.
No, there's no follow-up question coming. I was just going to go into my typical glass half full, glass half empty remark. You know, the glass half full is that operators who own existing stocks, as you pointed out, have been under pressure in recent years with new inventory that has depressed rents, and they could use a tailwind. And this will be helpful. This is constructive. They will hopefully benefit from a slowing new inventory growth in their local markets, and that will allow them to push rents up and recover from some of the doldrums that we saw in 2023 and 2024. The glass half full for our market. The glass half empty is, if this is a sign of confidence eroding, that would be a negative. If people are starting to say this is not the right time to put a shovel in the ground, we think that the U.S. economy is taxed, $100 oil is going to weigh on the U.S. consumer, that would be the glass half empty part of it. Let's hope it's more of an inventory rebalancing that's forcing this down drift in shovels being put into the ground and not a lack of confidence.
Mm-hmm. Right. Right. And while we're on the topic of confidence, I did hear a lot of it in New York City this week. I was there to give a market update at the MBA of New York's Real Estate Summit. And thank you to Popular Bank's Fred McDonald and LCS's Liz Mahoney for inviting me. It's a really great event for lenders and other CRE professionals in New York City. Manus, I built a theme of my talk around a quote that I love from Ted Lasso, which is 2 buttons that you should never hit are panic and snooze. And in talking to attendees, there were kind of 4 key takeaways that I heard. I would say the tone around debt capital markets was notably constructive. I mean, panelists described debt markets as open and They were asked about underwriting on one panel, and the sense was that the discipline remains firmly intact. So not a lot of concern there that the market's getting lax or throwing caution to the wind or getting more aggressive. Second was a point that I remember Shlomo Chop made on LinkedIn recently, which is folks who own properties should be getting used to running those properties like a business. And what this panel said was what lenders want right now from their borrowers is not just strong sponsorship, but they want to see demonstrated asset management to show that they can actively manage an asset through a volatile environment. Third was on distress, seeing a low-level constant flow of stressed properties, but nothing that's at alarm levels, and that the extend and pretend period that defined a lot of the last few years is kind of moving past that and clearing their balance sheets. And then last, when a panel was asked where the 10-year Treasury might end by the end of this year, they generally said in the mid-4s, which, admittedly is kind of where we are right now, slightly higher than today's levels, but nobody thought that they would get as high as 5%.
I'll go contrarian on that one for sure. I think we're going to be a tick above 4, maybe even under 4, but that all is conditioned on the war in Iran ending. I think we were under 4 before the war started. I think there will be enormous pressure over the summer to end the war, to push gas prices lower, especially ahead of the midterms. And I do think we revert back to that 4% level. I don't think that the president can let this war continue. Certainly, I've been wrong plenty of times before. I loved your commentary there. It sounded like everything I wanted to hear. Lending discipline is firm. Distress is not surging. It's staying at modest levels. And people are learning their lessons that operating a property through rough times is critical now more than ever. So great commentary. Now, I want to pivot for a second, Dianne. You've been traveling the country a ton. You've been talking to 1 million people out there through all 4 corners of the U.S. over the last couple of weeks. You talked also about an interview you did recently that you were very fond of. You talked about one that was really informative. Tell us about that.
I got to sit in the interviewee chair on a podcast for a change. So Jenna Hilly is with Coldwell Banker Commercial, and she invited me to be a guest on a podcast that she does for Coldwell Banker's women's group. So we really had a great conversation about career paths, my mentors, which was Anthony Bonacore. I got the opportunity to tip my hat to him. Things I wish I knew when I was starting out, and of course, the state of the market in these strange times. And after our recording, Jenna was kind enough to come to our Chicago client dinner when we were there for the road show. So I want to thank Jenna for putting me on our podcast, and she's looking for new voices. So if any of our listeners have suggestions about women in commercial real estate who have stories to share, let me know. And Manus, I have to say, not only was it fun to be on the other end of the mic, but being asked about my career path and lessons learned can only mean that I'm getting old.
I don't know. What's the old remark? You're not getting older, you're getting better. Wasn't that from the commercials in the 80s and 90s? For those that don't know Dianne, and I'm sure Alyssa is very eager to get to our data dive and our Did You Know, but for those that don't know Dianne personally, she pays it forward every day. She talks about her own mentor very generously, but she is a real active mentor and has been for a really long time. So everything about Dianne is authentic when you hear her talking about people around the country and what they've done for her. That is genuine. She doesn't spend a lot of time talking about what she does for other people, but it is really generous.
Thank you, Manus. That's so nice. One of the things we talked about was you reach a point in your career where you start thinking about how you can help those coming up behind, which was a lot of what started the LightBox Developing Leaders Mentor Program. We're in our 7th year, and it's amazing to see the mentees coming through and how ambitious they are.
Dianne, for this week's Data Dive, what are you seeing in the latest transaction tracker data?
Yeah, thanks to your team, Miss, for giving us another fabulous data set on closed deals. I just started digging into the April numbers, and they did reveal what could be the first small signs that uncertainty is starting to make a dent. The market's still very active overall, but there was a modest pullback, especially at the high end. So the 9-digit deals over 100 million slipped a little bit from 44 in March to 42 in April. And then in the $50 to $100 million bucket, deals dropped from 79 to 54. And then the last metric from the April deals that I'll share is the total transaction count, regardless of size, eased by about a 5% decline in April below March. So still very strong and not a freeze, but again, it could be the first sign that transactions, especially at the higher end, are starting to pause a bit.
And that's consistent with what we've been talking about on the podcast. You tend to look at these things in big bulk. You pull back the lens and you look at it kind of month over month and year over year. I'm looking at it as my team turns it in every day. So it's much more seat of the pants. But it did feel like we were seeing fewer 9-ticket numbers on a regular basis and fewer overall numbers as the register was changing every single day as the team was turning in its numbers. So the bigger picture really underscored what we felt like on the ground.
Mm-hmm. Exactly. And we're halfway through May, so we'll have to see how May shapes up.
Going by seat of the pants, I do feel that May has held up okay, right? I'll take a turn that April felt like a slowdown, but May has felt okay, at least as it pertains to my pea-sized brain and the data I look at coming through the pipes every day.
All right, Dianne, and for this week's Did You Know takes us to multifamily. What do you have for us?
Yeah, Manus and I collaborated on a multifamily research piece that came out this week, so I pulled from that. Did you know that multifamily listings in the LightBox Live platform were up 35% last year, and Q1 was level with last Q1, so still going strong. A lot of multifamily properties coming onto the market.
The LightBox Activity Index has really underscored this, right, for all year long, that listings have been growing and the wheels of activity continue to flow. So let's hope that that continues through the rest of Q2 and the war in Iran doesn't leave the dent that we are also concerned about.
Okay, let's move to the deals that caught your eye this week, starting with office. Manus?
Last week, we painted a fairly rosy picture about office. We talked about leases that are being renewed or new leases in New York and Washington, D.C. We talked about the pace of activity picking up, the strength of the rebound in places like New York, San Francisco, and Los Angeles. So it was a little bit of glass half full last week. The one story we have in office this week is the glass half empty. Menashe Properties in Chicago is under contract to buy 180 North LaSalle Street. The price is being rumored to be between $55 million and $60 million. That represents about a 70% discount from the nearly $200 million that seller La Caisse paid in 2016. And it just goes to show that there are still a lot of losers in the office market. We've been tending to focus on the bright spots. We are glass half full people. And we've been talking about at least a leveling off in some of these bad markets of the discounts, the fact that a lot of property sales are happening, so the market is clearing, and that there is AI momentum in certain markets. But here's that word again, somber reminder that there is still a lot of deep discounts taking place. Chicago, probably one of the biggest ones. We still see 60, 70, 80% discounts in the Windy City. And here was just another example of that.
Yeah, these trades look painful on paper, but they're all part of the process of helping to clear the market. And you're right, it felt like our conversation last week about the office sector was all wine and roses. So this is an example that there's pain to be felt too, as values reset to a level where buyers feel comfortable coming in and they can make repositioning and redevelopment math work again, even with rates high and even with concerns about volatility.
On the pain side, it is one of those things that, like, this was a known for a long time. We're only recognizing the pain now. For me, it's like the treadmill. You don't need to see what the treadmill is registering to know that you're slow. You know it before you get on the treadmill. The guys that were selling this property knew before the check cleared that they were going to take a loss. The only question was just how big. So for those that are kind of tourists in the CRE market, this is not an out of left field thing. People knew 2 years ago, the owners of this property, that they were probably going to take a 9-figure loss on this asset. 9-figure losses have not been rare over the last 3 or 4 years. This is just a recognition of the loss.
All right, moving on to a story and logistics that caught your attention.
There was only one big one that caught my eye, and maybe it caught my eye for obvious reasons, because I do like my beer, I have to admit. I don't know if you're a beer drinker, Dianne, or not. But the big story we saw was Anheuser-Busch selling a facility in Newark, New Jersey for $360 million. Goodman North America is going to take that property and redevelop it into a logistics center. A vote of confidence for that market, which continues to remain on its now 11-year rally. The logistics center rally began in 2015 when e-commerce became the trade du jour. It's continued for 11 years, almost uninterrupted. And here we have Goodman looking to spend a lot of money converting a property in Newark, New Jersey from a beer distribution center, I suppose. I don't think they make beer there, or maybe they do, into a logistics center. So with that, Dianne, let me ask you, do you have a favorite suds?
I'll take a Sam Adams any day of the week, never a Bud Light and never anything too hoppy. And don't even talk to me about putting fruit in beer. That just is never okay.
You don't like the sliced orange? That's not your thing?
Negative.
Gotcha. But I think those beer drinkers, I don't think you have anything to worry about. I think somehow Anheuser-Busch is going to be able to close this facility and yet still fill the aisles with Bud and Bud Light and everything else that they make. So fear not.
You can keep the Bud Light.
All right, wrapping this segment with a couple stories from multifamily. Manus?
A couple here in no particular order. In the Chicago suburbs, which has been on fire for quite some time, Sonia Properties paying $91 million to Venpoint and Matador Capital for a property in West Dundee. This is a 352-unit property that traded for $260,000 per unit. In Fort Lauderdale, LaFrac paying $180 million for a riverfront tower in Fort Lauderdale. That equates to about $530K per unit. Financing there came from Northwestern Mutual, so an insurance company loan in that particular case. And Cortland sold a Boca Raton apartment complex. I believe it was Uptown Boca Raton for $240 million. So multifamily properties, even in markets that have been challenged in terms of rental growth, and South Florida has been one of those markets, still getting premium prices in neighborhoods like Fort Lauderdale and Boca Raton. And in the Chicago suburbs, as Richard Hill predicted, that market remains very, very hot. People really looking to take over properties in that upper Midwest region.
I did a little research, Manus, into the Boca Raton deal. The Cortland deal was one of the largest South Florida multifamily trades of the year so far. And despite that article that you quizzed me on earlier about fewer shovels in the ground in multifamily, here's a fun fact for you and our listeners that there are roughly 7,600 apartment units planned or under development in the Boca area. So that tells me investors still believe in long-term demand drivers there. And it used to be a retiree market, but now financial services firms are relocating there and they're bringing young professionals with them. So they can live and work and not have to move anywhere when they're ready to retire.
It's interesting. I think that Mondami remarks that we referred to a week or two ago will only hasten people out of New York City. I know that they've backed off that pied-à-terre tax that they talked about, and I think they've tried to calm people from getting up and leaving New York. But I think some of the damage is done, and I think people will be flocking towards places like Charlotte and various cities in Texas and Florida and so forth. So I think this is, it's not the tip of the iceberg. I think we're probably halfway down the iceberg. I think that these moves have been happening for a long period of time. This will just keep them going.
Yeah, and I was actually surprised that at the MBA of New York event, there weren't that many people talking about Mamdani's efforts there. And I was certainly not going to ask. I didn't want to open that can of worms.
Probably smart. I think that once you get into the political realm, which is where Mamdani kind of resides, you're, playing with fire.
Yeah, indeed.
Okay, time for a slice of life. At road shows, we heard a lot of nostalgic stories about old school processes. What's the most outdated thing you remember from early CRE finance days? Dianne, you want to start?
Sure. I guess I'd have to say takes me back to my early days at an environmental consulting firm outside of DC. And I remember being the low man on the totem pole, and a senior executive taught me what she said would be the most important thing that I would ever learn as a consultant. And it was how to hole punch reports and put these plastic binder spines on them before shipping them to FedEx. And I hated it. And that just seems so archaic now.
I have a couple that I'll refer to in no particular order. One was you would need to get data from Fannie Mae or Freddie Mac, and you would do so by hooking up a modem. Your computer would have one of those telephones hooked up to it. You would dial a number and you'd stuff the phone into these rubber handles. You'd hear this phone dialing, and then you hear the hoping that the system would connect, and then you'd be on the Fannie Mae website and you'd be able to download your data. That would be one. I also remember before there was email that you would get prospectuses and there would be fold out tabs of paper in the prospectus, which would have all the data on all the loans in a deal. So maybe there would be 300 loans backing a particular CMBS deal, and you'd have to fold out this 8-tab piece of paper and run your finger down the line to say, okay, this property has 342 units, this has 180, this has 240, and you would have to mind-numbingly go through and enter data by hand. Eventually that gave way to discs, floppy disks being taped to the inside of prospectuses. So I really watched the CRE executive, or maybe the grunt, as I should say, march through that evolution chain that you see where the ape kind of transforms into a man over the course of time. Like I was that grunt, like basically on my hands and knees in the beginning, putting the phone into the modem, and then I became slightly upright, typing things in through a piece of paper. And then I became even more upright because I got to use a floppy disk. So that was my own personal evolution through the 90s.
And with that, we'll close. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.